I'm going to introduce Criag Klemmer. Criag Klemmer is a senior agricultural economist at Farm Credit Canada with experience in agricultural markets and risk. He specializes in monitoring and analyzing the macroeconomic environment, modeling industry health, and providing industry risk analysis. In addition to his speaking engagements on agriculture and economics, Criag is a regular contributor to the FCC Ag Economist blog. Criag came to FCC in 2009, joining the portfolio analysis and modeling team. His previous experience included 2 years as livestock specialist with the Saskatchewan Ministry of Agriculture, and prior to that he worked with the Canadian Wheat Board. In 2010, Criag earned a master's degree in agricultural economics from the University of Saskatchewan. And today Criag is going to talk to us about the future of processing in North America and Ontario.
Well, thank you very much for having me. Hopefully both mics are on. I feel pretty mic'd up here, and guess I needed a tie here just to hide the gear here. But anyways, thank you very much for having me. I'm going to talk about the future of the processing sector here in North America and Ontario and Canada specifically. What I really want to talk about is look at it from the drivers of what's going to drive that demand for processing sector, supply of hogs, some of the things that are impacting it from a cost side of things, and that competitiveness in the overall environment. And looking at it at that perspective and the hog sector specifically here. So that's kind of my goal here. I did throw a couple slides in terms of that cost production and for hog producers, and that's really going to be a big driver of this overall market, especially as we start talking about that supply. And that's really a big part of the story when we think about the future of the processing sector here in Canada and North America, because when we look at the overall dynamics, it's all about making sure that we have adequate supply, that we can take advantage of the market opportunities domestically and internationally. So with that, like I mentioned, I want to talk about 3 areas. I want to focus on the macroeconomic side of things, because that's going to be some of the biggest challenges for the processing sector. And these are some of the same challenges you're going to be facing on your operation too. Labor markets, growth, interest rates, etc. As I mentioned, I'll talk a little bit about that baseline for Canadian agriculture and that future of the processing sector. Starting overall, one of the places, I'm an economist, so I do have quite a few charts here and like to start with numbers, and really starting with that very top level number, economic growth and what we're seeing around the world. And when we think about what's happening around the world, it's starting to see some encouraging factors. World economic growth is strengthening. That's a good news story. Many of the economies around the world have struggled the last little while. We think about the European Union really struggling. We did see some slowdown in the Chinese economy. Growth in Canada, the United States was pretty muted over the last little bit, but we're starting to see some growth really after that financial crisis. And when we think about a chart, what we're showing here is that economic growth. And the darker the green we have, the better the growth is expected. So you have countries in Asia where are expected fairly strong and robust growth. And when we think about our market, that's where we're shipping our products to. So really continue to see growth opportunities in those areas. We've also recently had some trade agreements, and I'll talk about them a little bit later, but that also foster growth opportunities in some of these faster growing economies. Domestically, the United States is picking up some strength. They had relatively slow growth the last couple of years, but we're starting to see some momentum there. And with the U.S. being our largest market, that continues to be an opportunity moving forward. And domestically, we continue to sputter along here and around that 2%. We were the fastest growing economy last year, but that overall growth level seems to be slowing. With world growth going up about 3.7%, it does look encouraging overall for the Canadian pork sector. The one thing I would like to chat about this is when we think about growth, one thing of looking at it is it's really a proxy of income growth. So as we continue to see this GDP growth, it's rising income levels, which means rising expenditures on food, especially when we think about some of these export markets. Excuse me. The labor market is on fire, and when we look at what's happening, it's really that improvement in the Canadian economy, but this is what we've seen in the labor market. And we're right now at a 40-year low in terms of that unemployment rate. And when we think about the agriculture sector, we think about the processing sector, this is going to remain one of the largest challenges for us. There's a number of unfilled jobs in agriculture, and when we think about unemployment in and around this 5.5–6% area, it's going to continue to provide a number of challenges for the overall sector. And labor is one of the largest costs in terms of the processing sector. It's also a major cost and challenge for the producers as well. And getting that expertise, because although they're generally unskilled labor, if we don't consider the component of what it is overall for our cost of production, it's really going to put our processing sector at a disadvantage. So this labor market is something that's going to be really a challenge. And in Ontario, we've seen those wages increasing and therefore putting some additional pressure on the processing sector. This is just kind of speaking to the debt, but overall Canadians remain fairly highly indebted. Right now, for every dollar of income or disposable income, they're carrying about 1.7% or $1.70 in debt. And this really starts causing some problems in terms of that challenge and that affordability, and that impacts that demand side of the equation. And as we just heard from the retail sector, that low discount area seems to be the fastest growing spot in terms of that food retail space. And a lot of that really speaks to how healthy is that Canadian consumer. And as a result, where does that opportunity possess for our processing sector and the hog industry? Another challenge that's going to continue to face not only the processing sector, but the overall economy is really what's happening on that interest rate environment. Interest rates have been increasing and the yield curves continue to be showing higher numbers. And this is going to start putting some pressure on the consumer. It's going to put pressure and impact investment decisions about, do we upgrade our plants, do we invest in our processing capacity, or do we hold back on that? We have seen 3 rate increases since 2017, and the expectation is that we continue to see another 0.5% into 2018 with 2 more rate increases in Canada and similar moves in the United States. So this is really going to mean higher investment costs. It's going to mean higher cost of funds. It's going to impact that overall decisions about where do we invest and where do we invest that money on the processing side of things. Do we continue investing in Canada? Do they look to invest in some of the process outside of Canada at this point? Another thing that I think is really important that we think about this overall situation for processing and the hog herd is really what's happening on the cost of the dollar. This is such an important part of an export-dependent area. And as we see, oil really drives a lot of that value of the Canadian dollar. And right now, when we see where we are, we're sitting below that 80 cents. And for our perspective, when we start forecasting this, we expect that to continue to hold below that 70 or 80 cent mark. And that's a real opportunity. Excuse me. About 80% or 87% of the movement in the Canadian dollar is driven by oil, and hence why I see that petrocurrency. But when we start talking about the trade dynamics, the value of the Canadian dollar is really going to impact where are we competing relative to the US, and also some of the larger players coming out into the market. Overall, when we think about what's happened in the Canadian economy, since 2014, we've seen the value of the Canadian dollar go from above parity to where we are right now, below 87% or 87 cents. 78 cents. And as a result of that shift, it's really improved the competitiveness of our exports and also the sustainability of revenue domestically here in Canada. So when we think about the value of the Canadian dollar, it's going to really impact how we position ourselves currently and into the future. And that's something that's going to be really important, especially when we think about investments going forward. As I mentioned, the U.S. economy continues to be rebounding, and this is a good news story. When we think about pork exports, when we think about consumption, about domestically and internationally, we continue to see pork consumption increasing about 1% per year. And a lot of that's going to be driven by that growth in the economies, but also that improvement in the consumer spending. And it looks like we can create opportunities for higher value products moving forward. So I think that's a really good news story that we continue to see the U.S. economy improving and therefore helping to add some value to the exports that we're looking to accomplish here. So clearly there's some challenges though, what we're seeing in the United States. And one of the things that we got to recognize is that growth in the overall economy is going to be supportive of wages. And that's one of the challenges that we're not seeing right now in Canada or the United States, is that wage growth that's really organic based on that improvement in the overall economies here. So what we're seeing in the US, and I think it's quite interesting to see, is that historically, when we look at the US economy, as unemployment starts to increase, we see wage pressures coming down. And if we look at these charts here, we can see that by the lines. In the last couple times that we've had recessions or downward pressure on employment, we've seen wage increases start to decline. And then once we've seen a recover in the overall economy, recover in those unemployment levels, we start seeing that upward pressure on wages and therefore recovering. If we look at the most recent situation where we are right now, coming from 2014 to 2017, 18 time period here, we've seen some major declines in this unemployment area in the United States, declining from about 10% down to about just over 4%. And that's really impressive growth. But what's really challenging about this overall number is that when we think about the wage side of things, wages remain extremely low, and there hasn't been that upward pressure. So that causes a couple challenges. One is that when the consumer's looking to spend money, they're not feeling increasingly wealthy. They're more comfortable about their job situation in the labor market, but from the perspective of where they're going to spend money, there doesn't seem to be that same confidence level because we're not seeing that wage pressure increases. The other side of the story is when we start comparing our labor costs here in Canada, and particularly what we've seen in Ontario with higher wages, is that there's some competitive advantages that we see in the United States relative to where we're seeing them in Canada. And those are going to be some challenges that we need to consider moving forward, is how does that impact processing, and how does that going to impact where that investment's going to be in the future. So I think this is something that's really important to monitor, because really wages are such a big part of that overall cost of reduction when we start talking about our processing sector. The other side of the story that's important about that inflation is really what it means for funds rates and US interest rates. US interest rates right now look to be improving, and we're seeing them raise a little bit. The expectations is US interest rates will continue to move higher into 2018, in and around that same growth rates that we're seeing in Canada. And that's going to come into play for a couple reasons. One, it's going to impact our cost of funds here when we start talking about long-term investments. And two, it's also going to impact the Canadian dollar. I did mention that the Canadian dollar is primarily driven by the value of oil. The other thing that's extremely important to monitor on dollar is that interest rate spread between Canada and the United States. If Canada is looking to increase rates faster than the United States, or vice versa, it's going to impact that spread and therefore cause the dollar to be higher or lower. So if the US funds are going to increase faster than here in Canada, that's going to put some downward pressure on the Canadian dollar and vice versa. So it's important to monitor that and really what that means going forward. More importantly, and we talk about the health of the sector, is what's happening on this exports and where the opportunities are. Domestically, the consumer's doing a little bit better. We do see some wage pressures, but nothing really positive. And therefore, on the consumption side of things, the value is going to be added at the retail sector or in other parts of the economy here. Where some of the major opportunities continue to be is in the export markets. If we look at where exports have been growing, we continue to see growth in exports, significant growth in 2014, and looking at that kind of leveling off since now. So when we think about where the export's going to go and the opportunities, there's been some recent announcements I think are very positive for the overall sector and for future investment here in Canadian pork sector. First of all, if we start talking about the comprehensive and progressive trade agreement with TPP here, just call it TPP just because I find it a bit of a tongue twister saying comprehensive and progressive. But overall, this looks to be a pretty good opportunity. As I mentioned on my very first slide and showed the growth opportunities and where we're going, Asia seems to be one of the fastest growing economies in the world, or regions of the world. With this opportunity, or with CPTPP, we have access to some of the fastest growing economies, thinking about Indonesia, Malaysia. We have some very strong economies and high valued economies, mostly the Japanese market. We do also have some fierce competitors in this agreement when we start thinking about Australia. But why this is important is that we have first market access into some of these Asian economies that we haven't had access to in the past. So from the processing side of things, I think of two things. One is, as a processing sector, are we willing to step up and embrace these opportunities and add some value to the products that we're shipping out? Because we're very good at shipping out carcasses, but we're not as good about adding the value we need to when we think about these opportunities. But we do have first in market access in some countries, or at least we're leveling the playing field relative to the United States and some of our competitors into these economies. So the CPTPP agreement is a good news story for Canadian pork. Sita is another trade agreement that's been recently signed and ratified, and this is another one where I'd put that same challenge, but it's an opportunity. We have access to 75,000 metric tons of product going into Europe that we haven't had in the past. And not only that, there has been some countries within the European Union that were high export markets for, or larger export markets for Canadian pork, that we lost as they joined the European Union. So it's new opportunities, it's rebuilding of old opportunities, and that's moving some of the product from the Canadian market into these different markets and creating those opportunities. So from a processing side of things, it does require investment, which would be a good news story for the sector because it would create some sustainability, but it really looks to create some of these opportunities to move some product at higher value into the European market. So these are great news stories, I think, overall when we start thinking about trade agreements. Another one that's a really hot topic issue, and I can't provide a lot of insight on it, but the discussions in modernizing of NAFTA, or the withdrawal potentially, of what the United States is looking to do with NAFTA. And when we think about what this means, there's a couple challenges. If NAFTA disappears, it's going to have a cost, absolutely. It's going to be an increased transaction cost given the integration of our sectors, moving product back and forth. But when we think about overall in agriculture, those transaction costs are relatively low, but it does break some supply chains that have been out there. What's more important though, and not only just about NAFTA, but we think about the sensitivity of having the processing sector beyond our borders. Recently, we have seen some major expansions or some large investments in expansion of pork processing facilities in the United States, and that's created some opportunities for many people, probably in this room. But with those, it does mean increased transportation costs moving the product down to the United States, but it also creates a risk. If our product cannot move freely across the border, if there's increased transaction costs, it's going to put us at a disadvantage relative to the US and therefore cause some challenges for us and that viability long term. So the modernization of NAFTA and what that could mean is a big question mark. And unfortunately, I don't have many answers to this one as negotiations continue to be going off, but I think it's something that's really important to monitor. And it also highlights that sensitivity. So although we have a strong North American processing market, it does highlight that sensitivity and the dependence on our neighbors when we move forward. If I start thinking about one of the biggest challenges from the processing sector, it's really about where the product is. If we look at what's changed over the number of years, we continue to see processing facilities adjust to where the production is and the lowest cost of production is. And that's one of the challenges that we're going to continue to have in North America. Is the lowest cost of production going to continue to be in the United States, or is it going to be in Canada? And how are we going to compete to ensure that there's adequate and sustainable supply of pork or pigs coming into these processing facilities and to continue to add value? So I'm going to show a bit of our forecasts and move through this quite quickly because some of it isn't specifically to the processing sector. But overall, farm cash receipts in Canada are expected to continue to increase. We just saw the new outlook from Agriculture and Agri-Food Canada come out, and they're looking at growth very similar to what we have, growing in and around that 3% this year. What's really important, though, is what we look at Ontario hogs and where we think growth is going to be. And we expect that we continue to see growth in that. I just noticed that I didn't change that billions, but when we look at that trend line, expect pretty good growth in 2017 on the expansion of output or production, and looking at it flattening off somewhat in 2018, just responding to where we are for those overall levels. And why I'm showing these side of things is because it's really going to be on that cost of production that's going to impact producers in this room and the overall industry. Farmland values continue to be appreciating. We're forecasting growth in and around that, over 7% for 2017, and continue to grow in 2018. Low interest rates, improved revenues. We've seen expansion of some of the dairy industry, and that's all putting pressure on farmland values. So this is what our forecasts are for overall farmland values in Canada. And when we start looking at Ontario farmland values specifically, from that appreciation in and around that 8% growth in farmland values for 2017. And that at the end of the day, this is going to impact your cost of production, and it brings into the question, what is that sustainability, or what is that supply of hogs going to be in the market, and does that mean sustainability in the processing facilities? Just to kind of add some value to this so you can interpret what it means, if we look at a PE ratio, price to earnings ratio, and we look at Ontario specifically, that number continues to gravitate higher. I just caution when you look across the board on these numbers, you can't really compare Ontario to Saskatchewan because the diversity of agriculture varies so much. But what we're continuing to see is that these price to earnings ratios continue to be increasing, and there's a number of reasons for that, and that's not really for today, but something that's important. There continues to be opportunities evolving for Canadian pigs. The cost of production continues to be supportive. People are making money. We've had a couple, 3 or 4 good years here, and people are building equity overall. But there continues to be some challenges that we need to be considered. The U.S. hog herd is expanding, and is that supply or the demand on the retail side of things keeping up with that? Demand remains strong domestically and globally, especially for pork, and we see that especially in the Asian markets. But one of the big watch-outs that I think that we need to consider is that rebuilding of the Chinese hog herd, and I'll talk about that a little bit later. But when we did see the Chinese hog herd culling of essentially the size of the North American herd, and they're now starting to make some major investments after gaining some insight, gaining some new genetics, gaining some practices and expertise in this, and rebuilding that hog herd away from traditional areas. And it'll be interesting to see how that comes on, but I see that as one of the biggest threats for producers here, for the processing sector, and the threats on that export opportunities. So from the cost of production side of things and the margin side of things, this is our margin forecast for Ontario hog producers. As we mentioned, it seems that we've had very good margins for the last little bit. This is total cost of production. But we see some tightenings and seasonality in that side of the equation, but people look to continue to make money, and we'll continue to see some potential expansion in the hog industry here in Canada. And therefore, we continue to see some supply. So from the processing side of the sector, this is a great news story because it means that we're going to have adequate and strong supply of pigs coming into the plants that we currently have, and therefore we potentially could see expansion or some investments taking opportunities that we see in the export market. So from that overall hog margin side of things, a healthy producer means a healthy supply and opportunities for the processing sector. That being said, though, I talked about the Canadian dollar maybe too much at the beginning, or at least as the feeling is, but I really want to bring it home that how important it is. And I'm going to show a couple other sectors here beyond hogs, but the dollar is very important to the overall profitability. For every change in the value of the Canadian dollar relative to the US dollar, for every penny, It's going to have a $1 per head impact on hogs. So if we think of where we are and where we came from, in 2014 we were at a dollar that was parity, say. Now we're at a 78-cent dollar. You're moving 22 cents on the dollar right there. That's a $22 head impact on profitability, and that was for the good at that time. We have seen it the opposite way, and it putting increased pressure on overall production. And for interest rates, I'll show you what we see for everybody else. For cattle producers, for a 1 cent change, we're looking at a $13 to $16 per head impact on cattle producers. And probably more importantly in the room, a 1 cent change is going to have a $5 per acre impact on cash crops here in Ontario. So that currency is going to make a big difference. That same story happens when we think about the processing sector. For every 1 cent change, it's going to impact that cost of production and that competitiveness of our industry. The other side of the thing is how competitive are we against some of our competing markets in terms of feed advantage and cost of production. So one, obviously the classic is use the feed ratio. If we look at Ontario corn versus US corn, that feed advantage is starting to shift towards the United States if we start looking at some of the forecasts. So, we have had that feed advantage. We continue to have a number of other challenges that do raise that overall cost. But when we think about that feed ratio side of things and we project it into 2018, we do see an opportunity where there's a feed advantage in the United States as compared to Canada. So that just kind of puts a bit of a warning sign out there. Obviously, protein is in the U.S. protein production is really what's going to drive a lot of this. And when we think about what's happening, U.S. pork production continues to be expanding. We're going to see another inventory number coming out this week. Likely see that inventories in the U.S. are going to be about 3% higher. 2017 we saw good growth. 2018 we saw growth. There's only so much supply or so much demand in the world, and we're really going to be dependent on that. And because we're continuing to see this growth in production, we continue to see that investment in processing facilities in the United States. And overall, that balance is what's really going to be important. So when we start talking about the processing sector, there's mixed messages for the Canadian hog processing sector. The good news is that we continue to see consistent supply of hogs. Investment is increasing in the U.S., and investment in Canadian hog facilities, I'd say, has been relatively mixed. We have seen some investment, but not to the extent that we're seeing in the U.S., and it's hardly a modernization. It's been more of an integration and to just bringing the plants together a little bit better. So, from that side of things, I'd say it's a fairly mixed investment that we've seen to the overall benefit. And as we mentioned at the beginning, it's a supply issue. When we start thinking about what the U.S. has been doing in terms of that overall increase, that puts enormous pressure on that demand side of things. And is the consumer strong enough? Is the world strong enough to digest that increased supply? This is really when that conversation about what's happened in China really comes back into play. The good news story, if we think about the last 4 years, a lot of the growth has really been spurred by that opportunity that we've seen in China and the decline in their overall hog herd. But we know that they're reinvesting. We know that they're going to be investing in improved productivity, and that's going to displace some of our export opportunities. It's not so much what we see in our own market, it's how we're going to compete or how do we get our product into those other markets. So the question to me is actually, can we continue to find new markets with Sita, with CPTPP, to offset some of the dependence on the Chinese market while adding increased value to high-value markets like the Japanese market, to increase production or change the cuts that we're sending to Malaysia or Vietnam, and really taking advantage of that. Can we send hams into the European Union and take advantage of these opportunities that we have? And all of that's going to require investment. I think from the producer side of things, we've proven that we have the supply there. We have the willingness to produce the pigs that we're looking for. Now some of the question needs to be put forward on the processing side of the story. So overall, we do see a lot of opportunities. And as I just mentioned, the demand for pork remains strong. We continue to see pork demand increase about 1% per year. If we look at what the FAO, OECD rate forecasts are, we expect that continued growth in emerging economies is going to increase that overall world demand. How does Canada fit into that and be part of that? Historically low interest rates continue to create opportunities. Right now is a good time to invest in terms of cost of funds, but is it the right time for those business plans? And I would argue, yes, that we have the time right now to be investing and that these historically low interest rates are supportive of that. The dollar does remain supportive relative to the euro, relative to the Canadian dollar, and these are all opportunities to make sure that, or to support why investment right now is good and why we expect for them to grow moving forward. There's a number of questions though, and there's some challenges. And obviously the increased market access is an opportunity. There is the headwinds though, and this is what really needs to be balanced off on that investment side of things. Labor continues to be a challenge. You know, this isn't something new to the processing sector, but the processing sector has an even tougher time finding people to work as compared to other parts of the agriculture industry. And you guys in the room already know the challenges it is to have good labor, good reliable labor in your facilities as well. Market access and trade disruptions, and I think mostly on that US side of things, is it time right now to invest when we have uncertainty about that movement across the border and what that means for transaction costs? You know, the US is our largest market for both pork as well as for live hogs, and therefore those create some challenges. And finally, you know, this growing Chinese and US inventories and processing really gravitates to where's the supply. And we're doing a pretty good job here in Canada, but we continue to see expansion of the US herd even more. So those are all some questions that I think that are really important that we consider. The one advantage that we do have in Canada from the processing side of things, and why I think the future here remains pretty strong, is that, you know, the processors, the big processors of pork here in Canada are uniquely Canadian. And they've proven a real commitment to be part of this industry. And I'm thinking Ollie Mill and Maple Leaf as two of the largest ones. And that really forms a good base of that processing sector and strengthen the processing sector. They haven't invested significantly beyond the Canadian border, and therefore they're going to be relying on Canadian supplies of pigs to fill their processing facilities. How do we add that value, and is there some desire to expand that? We have historically had a number of challenges, as I mentioned on the labor side of things, to run these plants at full capacity, and therefore those are some concerns. But when I think about the future of processing here in Canada and North America, I do think it's relatively strong. I would like to see more of that processing investment here in Canada because there's a lot of opportunity here. We have a lot of things stacked up really well for us for the future. As mentioned, CFIA rules. We have a fairly decent labor supply, but we do have challenges getting the right labor into the processing opportunities. Mechanization may help with that in the future. We have favorable interest rates in terms of cost of funds, in terms of making that investment pay off over time. We continue to see access to markets increasing and opening up, and that's a good news story to see where can we add some value and really take advantage of the growing world economy. So I think all those things are pointing to a pretty positive future here in Canada. But as it's always been, processing really moves to where those opportunities are and where that volume of pigs are going to be. So making sure that we have a healthy producer here in Ontario, in Eastern Canada, is going to be one of the vital components in terms of ensuring that we have that long-term sustainability and that optimistic future for the Canadian processor. So as I mentioned, overall I think this is a positive story. I think we're in a positive position in the hog industry right now. There are a number of headwinds out there that we need to make sure that we're cognizant of. And the biggest ones for me, and I've talked about it several times, really is on that labor side of things. Interest rates remain low right now, but they're increasing. The consumer here in Canada remains sensitive to rate increases, and we've seen some stress testing side of things from the Bank of Canada. A stress right now to really hurt the Canadian economy is a 2% increase in interest rates. So you just see how tight the household budgets are of consumers and what that's going to mean for their demand for products. One of the positives that we continue to see, I think, in this industry is that poultry prices are increasing and consumers are starting to back away from that chicken breast market and looking for opportunities, and therefore we're seeing growth in demand again for pork, for beef, as that that cost-sensitive producer looks to find opportunities to make sure they feed their household. And so overall, I think this outlook remains pretty positive, but I think there's a lot of headwinds out there that we got to be cognizant of the future. I have about 3 minutes here, according to the clock, for questions, but thank you very much for having me.
So I know this isn't one of those sessions where you take something home at the end of the day and apply it in your barn, but given our dependence on the export markets and the fact that it's the aim of this industry ultimately, I think, to provide healthy, high-quality protein to people in Canada and around the world, I think this is a part of our business that all of us need to learn a bit more about and understand a bit better. So with that, I'd like to invite any questions for Craig or any other questions that might occur to you to ask John at this point.
When we look at that growth opportunity, the fastest growth is expected to be Africa and parts of Asia. And I think with that, it's important to identify, we haven't focused as much on Africa. We don't have the trade agreements with Africa. And that's going to be one of the challenges that we're going to have to be looking forward to. One of our largest competitors is the European Union. Due to the history, they have a little bit more integration and ties to the African countries, and those vary by region. So that's going to be a challenge. From location perspective, Ontario is very well poised for that, to access those markets. So I think that's a future opportunity. I don't see as that being the market opportunity right now. When we look at where the income growth is, they're seeing some very large income growth now, but it still isn't in that level where we're going to get the prices that we need for our producers here to be sustainable long term. And we're getting those right now in Asia because the incomes are growing quite quickly. But as the affluent population, the middle class population continue to grow, I see more and more attention being paid to the African countries, especially from Ontario because of the proximity, port facilities, and a good shot there. But just not right now, but longer term, absolutely. I think it's a great spot.
Any other questions? Well, if not, help me thank our two speakers once again for a very interesting afternoon.
Okay, thank you so much.